All done. All silent. Going. Gone. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Ciaran O'Brien, and as always, I've got my good friend with me, Peter O'Malley. Peter, how are you?
Oh, really good, Ciaran. Great to see you.
Yeah, great to see you, Peter. Look, just want to jump straight into it today, my friend. RBA this week announced another rate rise. Expected by some, not expected by others. What we want to know, though, what does it mean for the Sydney property market?
I don't think it's good news for the rental market, Ciaran. I think landlords will be feeling almost forced to keep increasing rents to offset the higher mortgage costs they're going to be hit with. Landlords are probably going to be able to get away with doing that because of the housing shortage in the city. So it doesn't just spell bad news for mortgage holders, it does spell bad news for tenants, unfortunately. There is a group that benefit from higher interest rates which are not spoken to often enough, and that is people that are fortunate enough to be sitting on strong cash savings and they're getting a higher return on their cash, and that tends to be retirees and the wealthy. And they're the segment of society that are, having a major contributory effect on the inflation that we're seeing here domestically. In terms of the property market, in terms of the sales, I think we'll find that the top end will be impervious to this rate rise, and the mortgage belt will continue to be hollowed out and severely impacted by this. When you're referring to the Sydney market, I think it's fair to say that the further you go into the suburbs and head west, if you like, the bigger the impact will be. And the more you head toward the eastern suburbs and the North Shore, the less impact there'll be.
Yeah, not surprising. We've certainly talked before about how some of the top end of town can weather some of these changes. I'm interested to get your thoughts. We've spoken before about the factors that contribute to the CPI figure, and that's one of the reasons that Michelle Bullock and the RBA made this call. The figures this week show that the only real driver is fuel prices at the moment, and that's something that's coming from offshore. How can the RBA, do you think, justify raising rates when it doesn't seem like there is any locally generated inflation at this point?
Oh, some would contest that point. So fuel spreads right across the economy, particularly in Australia, where it's there's 25 million of us, but we're spread out across the biggest island in the world. So increased fuel costs play a massive role in the inflationary issue. But look, I think the RBA had to go with a rate rise this week. Unfortunately, they're well behind their global peers. Inflation is showing in signs of kicking again. And if they've overdone it, they can cut rates.
Yeah, wouldn't that be nice?
It will happen at some stage, but that's for sure. But I wouldn't be getting caught up in the soft talk that they shouldn't have risen rates. I think the people that were saying they shouldn't raise the rates on Tuesday, they were coming not from a hard economic perspective. They were coming from the emotional and human toll of it, which is completely understandable and noble. But the thing with inflation, the longer you take to tackle it, the harder it is to tackle at the other end. You've seen that with many countries around the world over the last 2 or 3 decades, where they have massive inflation, rampant inflation, and it ends in social unrest. So the RBA is doing the tough decisions at the moment. And, quite frankly, it was a little bit alarming. The government attempted to lean on the RBA with their decision. By the time we got to decision day, the government had backed off, and we're talking about shelving massive infrastructure projects because the IMF was saying Australia's paying too much for its massive infrastructure projects because there's so much going on in the country at the moment. And if the governments back off a little bit, the cost of those mass constructions will come down.
So do you think the government was trying to take a bit of a softer position to protect their own image? As, we've seen in the past that the RBA's decisions are, or in many cases, broadly unpopular. Do you think that, Jim Chalmers was trying to say, hey, well, we've tried to stop them, we did our bit, and we're just going to sort of step away now and enjoy the rest of the cricket?
No, not at all. He was saying that the material outlook for inflation pulling back hadn't changed through one month's poor reading. And there's others who are highly credible that are saying the same thing. But the reality is that inflation bounced again after tracking down. And you can say that it was as a result of the shock to the oil price coming out of the Middle East dramas. But nevertheless, inflation bounced again. And the RBA can't afford to sit back and hope that it's an aberration and it'll keep going down, because if it rises 2 months in a row, they're well behind the curve. So it's not that people who are saying there shouldn't have been a rate rise on Tuesday, it's not that they didn't have a credible perspective. It's never a black and white decision, but when you put it all together, the market absolutely and utterly demanded that the RBA increase rates, which is what they did.
Yeah, and they've gone for short-term pain for long-term gain. I've read recently, Pete, that some economic commentators have suggested that the mortgage cliff is a bit of a myth, that people are doing just fine, and in fact there are no problems out there for mortgage holders in the real estate market. Is that the sense that you get? I mean, we've spoken in the past. It doesn't seem like we have found that to be the case, and I find it to be a pretty odd statement from someone whose job is economics and what's happening out there in society.
Yeah, look, I think any comment that the mortgage cliff has passed and it's not going to be an issue in our economy is premature. Savings, the ability to sell other assets, the lag effect of higher interest rates chewing away at people's disposable income, that all takes time to flow through. I must say I was one of those people that thought the mortgage cliff would have played a bigger role as of November 2023 than what it has. But just because it hasn't is not to say that it's not going to in the very near future. Westpac have claimed that a vast majority of the people who locked in low rates during the COVID era with them still need to refinance. And if Westpac is seeing that, other retail banks are seeing the same thing. And being able to pay the higher interest rates for a month or 3 or 3 months or 6 is one thing. But being able to pay interest rates at these levels, the mortgages at the levels that they are for 12 months a year, well, we'll find out this time next year whether that's sustainable or not.
Oh, look, my own personal experience, it's incredibly tough to pay extra. And it's, one of those things where we're eating away in our savings and we're every month a bit more is coming off the safety net. So I can certainly understand how people are going through this.
So what's really interesting at the moment, the RBA forecasts are saying that they'll need elevated interest rates until into 2025 to return inflation back to the levels that they want it to be at. Whereas if you look at the money markets and where they're betting interest rates will go, they think rates will be cut in the middle of next year, and it's exactly the same in America as well.
Yeah.
So the markets are second-guessing central banks' ability and forecasts, but central banks are beholden to modelling. They're data-dependent, as we keep seeing, and then they extrapolate what that data is telling them. And the data was facing in a direction that was telling the RBA that inflation was going to bounce, which is why we got the increase this week. But money markets don't believe the story for what it's worth.
Yeah, it's constant back and forth between the two. I'm interested to get your thoughts, Peter. You mentioned Westpac there, actually, and I might have been last week, the week before, read something about them shifting to some of their lending now to be a LMI-free 100% borrow model. Given that obviously house prices are part of this inflationary picture and this environment that we're in right now, and it's something that is important to us, what role do you think this is going to play in Sydney house prices as we move forward if some of these loans do make it out into market?
I can't imagine the banks are going to go en masse trying to buy market share in the mortgage market at the moment, but all banks feel a sense of obligation and duty to nurse vulnerable borrowers through, and whether that's keeping them in the game long enough so they can divest of their home if they're under pressure, or coming up with what they wouldn't have previously accepted as a new model of payment to get people through that have been caught by surprise at the fact that we've had now 13 rate rises in a row when we were told we wouldn't see any rate rises until next February, at least, February 2024.
I look forward to the first episode we do, Peter, where we do not discuss interest rates, I'll be honest. Yeah. I can't wait.
Yeah. So what's important also about that 13 rate rises in a row is that one of those was a double rate rise. So it's the equivalent of 14, of course. Yeah.
Could you not argue from the other side, though, that the banks going to 100% no LMI is a reckless move that could just perpetuate this cycle that we're in at the moment, and in fact has nothing to do with being supportive, but is under the guise of being supportive, and in fact is probably more damaging?
I think you could definitely say that, but that's been the case for 20 years. That every time there's been a potential dip in the market, that just seems to be hit with a wave of liquidity. I sold a terrace in Birchgrove in 2003 for $800,000. It resold in 2019 for 1.6, so doubled in
15, 16 years. Yeah.
16 years. And then the same property, without any work done on it since 2003, just resold for 2.4. Yes. So it's jumped 50% in 4 years, having taken, what did we say, 16 years to double.
Yeah, it's unbelievable. And all of that, and I have to remind myself of this all the time, all of that through a pandemic, an unheard of pandemic in our lifetime that completely rocked, society's foundations, and still, against all odds, property has just kept rising, particularly in Sydney. It's blows my mind, that's for sure.
Yeah. Well, it speaks to the way that money's been thrown at the market, and it's just fueled, dare I say it, this bubble. Can the bubble continue? Well, if there's 500,000 people coming into the country each year, and we're building 100,000 dwellings each year, which is about enough for 220,000 people, property's probably going to still continue to do all right in Sydney.
On that note, I'm interested to get your thoughts again. Read another article this week from another respected economist talking about now, in order to buy a property in Sydney, particularly if it's a single income household, you need an average salary somewhere around $250,000 to be able to buy. Now, I don't know about you, but that seems just ridiculously high and completely out of reach for the vast majority of people. Is that your experience? Do you think that that's realistic, or do you think?
Well, the median house price is $1.4 million, so I assume they were saying if I wanted to buy a $1.4 million house, what do I need to be earning? Is that right?
Yeah.
Yeah. So look, most people don't start with a $1.4 million house. That's the first point. They start with an apartment that's of lower value, pay some off, get some capital growth, sell that, and then use that to upgrade. The banker mum and dad is playing a big role here. So I think one of the really, really unfortunate side effects of COVID, the COVID pandemic as a whole, if you like, not the virus individually, is that the wealthier have got wealthier and the mainstream are falling further behind. So it does help to have parents that can help you in this environment, there's no doubt. And they're normally not taking money out of their bank account as such. They're normally borrowing against other assets that they've accumulated over time. So the bank of mum and dad are a big player in the market at the moment. That's a single person that you spoke to there.
Yeah.
So if you've got a two-person income for the household, that becomes much more manageable and easier again. So yes, the article there has gone to the extreme. I'm a single person who wants to buy a house. How much money do I need to be earning? And there are people that fit that characterisation, but there's many that don't. There's lots of permeations that make up the property market.
There certainly is, and there's properties for everyone, as you say. The smart people go straight in. We're going to keep it nice and short today, Peter, given that it's been a big week, obviously. Just as a bit of a wrap-up for the weekend then, any thoughts on where the numbers are going to be this week, whether we're going to see any bit of an uptick in what's happening on the ground with numbers at open homes?
Look, it'll be interesting. We're obviously catching up the day after the rate rise, the day after Melbourne Cup. We've had some open houses today. They've been well attended. That's good.
Yeah, it's good.
That's a bit of a surprise, if I can be honest. Louis Christopher's numbers came out yesterday for the week ending November 5. He had the auction clearance rate at 50.8%, which is, an evenly poised market. It's a 50-50 market. What you could say positively about these numbers, though, Ciaran, is that there were 1,276 scheduled auctions. So volumes are up sharply, and the auction clearance rate's at a reasonable 51%, 50.8%, as I say. Same week last year, the auction clearance rate was 49.9% from 860 auctions. So you can see this time last year that there were, what's that?
About a third less.
30% less auctions and a slightly softer rate. So for the week coming, there's 1,250 auctions, 1,247 to be precise. That'll be the first round of auctions after this new rate hike, so it'll be very interesting.
last week we had about 1,200 auctions as well and a very similar clearance rate. So I'd say in the conversations we've had over the last couple of months, that's pretty close to being the first time it's held relatively steady at a slightly higher rate for quite some time.
Yeah, if you look at the graph, it's gradually edged down from about 62% to around 50 over the last 3 to 4 months.
Very good. Well, look, as always, Peter, thanks for the wrap-up. I look forward to catching up with you next time.
Indeed. Thanks, Ciaran.
And thanks to all of you for listening. We'll see you next time on Current Market Insights.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.